What if the real superpower fight of this century isn't fought with jets or speeches, but with balance sheets, vaults, and code? While headlines scream about tariffs and trade drama, a quieter contest is unfolding underneath everything. Who controls the system that the world uses to store value, settle trade, and escape risk? For decades, the US dollar didn't just win, it became the default setting of global commerce. Oil, shipping, commodities, debt, most roads led through dollars. That gave America a kind of invisible leverage most people never notice until it's used. Now that leverage is being challenged. China is building routes around it. Other countries are hedging. And in response, a new American playbook is emerging, one that looks less like one policy and more like a three-part strategy: trade pressure, digital assets, and gold. In this video, we're going to connect the dots: why Bitcoin suddenly matters at the government level, why gold, an old asset, could become the ultimate financial lever again, and why tariffs aren't just about factories, they're also about forcing the chessboard to tilt. To understand the stakes, you have to understand what reserve currency really means in plain language. When the dollar sits at the center of global trade, it becomes the world's most trusted middle layer. Countries don't need to fully trust each other because they can trust the currency used to settle the deal. That's why so many international transactions move through dollars even when the US isn't directly involved. This creates a powerful loop. If countries need dollars to trade, they hold dollars. If they hold dollars, they buy US assets, especially US government debt. And when global demand for treasuries stays strong, the US gets to borrow cheaper than almost anyone else. That's not just convenience. That's structural power. It's also why control of payment rails matters. If global trade and reserves rely on dollar-based infrastructure, then access to that infrastructure becomes influence. In simple terms, when you control the toll roads, you don't need to win every argument, you control the routes. But the center doesn't hold forever. Once countries start asking, what happens if access gets restricted? They begin building alternatives, not because they hate the dollar, but because they fear being trapped in a system where one player can change the rules mid-game. That's the backdrop for everything else you're seeing: diversification away from one currency, one network, one settlement system. And once that trend begins, it doesn't have to replace the dollar to reduce its dominance. It only has to create options. Options are the enemy of monopoly. And reserve currency status is, in many ways, a global monopoly of convenience. Here's where people get confused. The dollar can still be strong and yet still be losing ground structurally. Reserve status isn't a switch that flips overnight. It's a slow shift in portfolios, contracts, and habits. A few percentage points here, a few settlement deals there, and then one day the world wakes up and the old default isn't default anymore. China has been working for years to reduce global dependence on dollars, not through one dramatic announcement, but through many smaller moves: promoting trade settlement in local currencies, expanding alternative payment channels, increasing gold holdings, and building digital systems that don't require dollar-based intermediaries. The crucial detail is this: countries don't need to dump the dollar to undermine dollar dominance. They just need to use it less. If you're a central bank, you don't go from 60% to 0%. You go from 60% to 55%, then to 50%, then to let's spread our risk. And once risk management becomes the primary motive, it becomes contagious. One country hedges, then another. One trade corridor tests non-dollar settlement, then another follows. It spreads not because it's ideological, but because it's practical. That's why the story isn't the dollar is dead. The real story is the dollar is facing competition it didn't face before. And in a world where reserve status is about trust, liquidity, and infrastructure, competition doesn't have to win outright. It only has to reduce dependence. So when you hear numbers like the dollar's share of global reserves declining over time, don't interpret it as a headline apocalypse. Interpret it as a signal. The world is slowly preparing for a future where no single currency has the same dominance it once did. That's the new arena. And the US response isn't just one move, it's multiple layers aimed at different time horizons. On the surface, tariffs look like a blunt instrument. Make imports expensive, protect local industry, pressure an opponent. That's the headline version. But strategically, tariffs can function like controlled economic stress. They force companies to reconsider supply chains, push negotiations faster, and create uncertainty that makes opponents spend time reacting instead of planning. In this script's framework, tariffs are the visible part of the strategy, the part that dominates news cycles and keeps pressure high. But the deeper function is leverage, forcing China to face costs while the US tries to reposition economically. One major effect has been supply chain diversification. When tariffs rise and unpredictability becomes normal, businesses hedge by moving production elsewhere. Not always back to the US, often to other Asian manufacturing hubs. That matters because it gradually weakens the single country chokehold that made China such a central factory for the world. Then there's the retaliation layer. When China responds with tariffs, restrictions, or export controls, it can create targeted pain in sensitive industries. Rare earths are the classic example, critical inputs for advanced tech and defense. When a country controls a large share of supply, it has bargaining power that doesn't show up in consumer headlines until suddenly it does. So tariffs become part of a wider game: pressure, rerouting, and bargaining chips. But here's the twist. Tariffs alone don't solve the bigger issue, the global monetary contest. They can reshape trade flows and manufacturing exposure, but they don't automatically preserve dollar dominance. That's why tariffs are only one prong. The other prongs, crypto and gold, are about something deeper than trade. They're about store of value competition and financial infrastructure competition. Think of this strategy like layered defense across time. Short game. Tariffs create immediate pressure and force negotiations. They also accelerate supply chain reconfiguration, which reduces China's manufacturing leverage over time. Medium game. Digital assets, especially stablecoins and Bitcoin, become tools in the competition for financial relevance in a world moving online. If the future of settlement and savings becomes more digital, the system that wins the digital rails wins influence. Long game. Gold sits in the background as the ultimate reserve fallback. It's not a network, it's not a promise, it's an asset that doesn't require permission from another country's payment system. In this framework, you can see why these layers can reinforce each other. Trade conflict pushes countries to seek alternatives and hedges. That can increase interest in non-dollar settlement options, alternative rails, and neutral reserve assets like gold. It can also increase demand for dollar-linked stablecoins in places where banking is fragile, because stablecoins offer dollar exposure without needing the traditional banking system. At the same time, if the US positions itself as the center of regulated, dollar-linked digital liquidity, it can preserve influence even if the old banking-centric dominance weakens. And if global uncertainty rises, gold tends to benefit, raising the value of official holdings and increasing the perceived power of those reserves. So the strategy isn't tariffs win the war. It's more like tariffs create pressure while the US tries to strengthen other forms of financial leverage. The question isn't whether each tool is perfect. The question is whether the combined system creates enough force to slow the shift toward a multipolar financial world, or at least ensure the US remains one of the dominant poles. For most of its life, Bitcoin lived on the edge of mainstream policy. Then something changed. Governments started thinking about it the way they think about reserves. A strategic Bitcoin reserve in this narrative signals a new concept: Bitcoin as digital gold. Not because it replaces gold, but because it occupies a similar mental category: scarce, global, portable, outside any one country's direct control. The logic is straightforward. If the world is fragmenting into competing payment systems and competing currencies, then holding an asset that is not tied to any single nation's policy becomes attractive. That's why Bitcoin is discussed in the same breath as reserve hedging. Now, compare that with China's direction. Rather than embracing decentralized crypto, China has favored a centralized digital currency model where the state has visibility and control. That creates a different kind of appeal. Some countries may prefer the efficiency and structure of a centralized system. Others may fear the surveillance and control that come with it. So Bitcoin becomes part of a values-based positioning too: open networks versus tightly managed networks. But there's also a strategic communications layer. We are preparing for a world where value moves digitally at scale. That matters because reserve status isn't just an economic phenomenon, it's also psychological. It's about confidence that your system will still be relevant in the future. A reserve strategy that includes Bitcoin is a bet on the digital future, while also being a bet that the asset's scarcity premium could rise if more institutions treat it as a long-term hedge. Of course, it's volatile. That's the criticism. But volatility is not the same as irrelevance. The real issue is whether states begin treating it as a serious reserve category over time. If they do, the price becomes secondary to the bigger outcome. Bitcoin becomes another layer of global financial infrastructure. If Bitcoin is the headline, stablecoins are the plumbing. Stablecoins matter because they extend dollar usage into places where traditional banking doesn't reach, or where local currencies are unstable. In many emerging markets, stablecoins act like a portable dollar account that works 24/7 without needing a strong local banking system. That changes the game. Instead of the dollar's dominance relying mainly on banks, correspondent networks, and SWIFT-linked rails, stablecoins can make dollar demand persist through crypto rails. And here's the key. Stablecoins typically hold reserves in dollar assets, including U.S. Treasuries, which can reinforce demand for U.S. debt indirectly. So the concept of digital dollarization becomes real, not by forcing countries to hold physical dollars, but by making dollar-based tokens the most convenient tool for saving, trading, and settling. In this framework, regulatory moves like creating clearer stablecoin rules aren't just tech policy, they're monetary strategy. If the U.S. can establish credibility and standards around stablecoins, it can position itself as the anchor of the digital dollar ecosystem, especially as other countries pursue competing digital currency models. Now contrast this with China's approach again, a state-controlled digital currency designed to integrate into China's trade sphere and expand yuan settlement. So you get two competing models, dollar-linked stablecoins spreading through decentralized networks and global exchanges, state-backed digital currency systems expanding through bilateral trade corridors and controlled financial rails. To countries choosing between them, the question becomes, do you want convenience and openness, or control and centralization? Many won't choose one, they'll use both. And that's exactly what a multipolar system looks like. Stablecoins aren't flashy, but they might be the most practical tool for maintaining dollar relevance in a digital future. Gold re-enters the story for one reason. It's the reserve asset that doesn't depend on trust in another country's payment rails. If a nation fears that foreign-held assets can be frozen, restricted, or politicized, it looks for something neutral. Gold historically plays that role. It sits outside the digital permission system. It doesn't require a counterparty to approve a transaction. It's slow, but it's sovereign. Now here's the interesting part. The U.S. holds massive official gold reserves. But official accounting values can be wildly different from market prices, creating a gap between book value and real-world value. That gap fuels speculation about revaluation, an accounting recognition that could, in theory, improve the government's balance sheet without issuing new debt because the asset already exists. Historically, governments have used gold policy in moments of monetary stress, and in a world moving toward multiple reserve assets and multiple monetary centers, gold can become more strategically valuable, not less. China's gold accumulation fits neatly here too. When countries diversify away from dollar exposure, gold often becomes a preferred hedge, especially when they worry about sanctions or asset restrictions. The more countries buy gold, the more gold's market power can grow. And the more gold's market power grows, the more valuable large official holdings become. So there's a paradox. If dollar dominance weakens and uncertainty rises, gold may rise, making America's gold position more powerful precisely at the moment the dollar's monopoly is being questioned. That doesn't guarantee a reset, but it does mean gold becomes a kind of insurance layer in an unstable monetary transition. And in chess terms, insurance is what allows aggressive moves elsewhere. China's response strategy, at least in the way this narrative frames it, is not just retaliation, it's construction. Instead of trying to defeat the dollar directly, China has focused on building alternatives. Payment systems that can settle without relying on the same rails, trade settlement in yuan, swap lines that provide liquidity support to partner countries, and digital currency experiments that reduce reliance on external intermediaries. This is the patient approach. Build a parallel ecosystem, expand it region by region, and let economics do the persuasion. That's why initiatives around cross-border settlement matter. It's not about replacing the dollar everywhere. It's about making non-dollar settlement normal in specific corridors, every trades, commodity flows, regional supply chains. Then there's the targeted leverage approach, export controls, strategic restrictions, and selective pressure points that can create outsized impact, especially when they affect inputs that are hard to replace quickly. So while the US uses tariffs as visible pressure, China builds structural alternatives in the background. It's two different styles of competition, pressure versus architecture. And this matters because whoever builds the easiest rails tends to win over time. Businesses don't choose systems because they love geopolitics. They choose systems because settlement is cheaper, faster, safer, or more predictable. That's why the contest isn't just Trump versus Xi. It's competing infrastructure models. The outcome will be shaped by what companies and central banks adopt, not just what politicians announce. In other words, the real battlefield is adoption. The winner is whoever becomes the default in the next era. And that default might not be a single winner at all. The most realistic outcome is a fragmented world where multiple systems coexist, each dominating different regions and different use cases. No strategy is free. Each prong introduces risks that can backfire. Tariffs can raise consumer prices, squeeze businesses, and trigger supply shocks. Even when companies diversify supply chains, the transition isn't painless. Costs move, timelines break, inventories get messy. If uncertainty becomes permanent, investment slows. There's also legal and institutional risk. If trade actions face court challenges or policy whiplash, businesses may hesitate to commit to long-term changes. Uncertainty can be its own tax. Crypto strategy has its own vulnerabilities: volatility, political backlash, and accusations of conflicts of interest. A reserve-like approach to a volatile asset invites criticism because it ties public perception to a market known for violent swings. Stablecoins raise questions about regulation, systemic risk, and the possibility of shadow banking behavior if oversight fails. If stablecoins become too large without trusted standards, they can create new financial fragility. Gold revaluation, if pursued aggressively, can be interpreted as strength or desperation depending on how it's framed. Markets can respond in unpredictable ways. Some may see it as smart balance sheet modernization. Others may see it as accounting theatrics that signals underlying fiscal stress. And then there's the biggest risk of all. Weaponization of economic tools can accelerate the very diversification it was meant to prevent. When countries see the system as conditional, they hedge harder. When they hedge harder, dollar dominance erodes faster. So the strategy has to thread a needle, apply enough pressure to gain leverage without pushing the world into building a permanent exit. That's the tightrope walk, and it's why the outcome can't be judged in weeks or months. This is a multi-year transition playing out in slow motion. So where does all of this go? One future is status quo drift. Tariffs stay elevated but fluctuate. Crypto reserves exist but remain modest. Gold stays politically sensitive, and the dollar slowly loses share but remains dominant. Another future is digital dollar dominance. Stablecoins explode in usage globally. Dollar-linked tokens become the default for online settlement. And the dollar remains central, just through new rails rather than old banking systems. A third future is a major monetary reset. A crisis forces dramatic policy moves, possibly involving gold policy, debt restructuring dynamics, or rapid shifts in reserve composition. These moments tend to arrive suddenly after years of quiet pressure. And a fourth future is accelerated fragmentation. Multiple systems emerge as true competitors: dollar rails, yuan rails, regional currency blocks, commodity-linked settlement in some corridors, and hybrid systems where countries mix and match based on politics and pragmatism. The most realistic outcome is a blend. Not one clean ending, but uneven change. Some regions go one way, others go another. Some industries adopt stablecoins rapidly, others stick to traditional banking. Some countries align more closely with China's model, others avoid it. For regular people, this is not abstract. These shifts influence inflation, interest rates, job markets, and the price of goods. They affect how safe savings feel, how fast capital moves, and how shocks spread across markets. The biggest lesson is simple. The system of money is not fixed. It's architecture. And right now, that architecture is being renovated while the building is still occupied. So here's the real question. Are we watching a brilliant defensive strategy or the start of a world where no single player controls the game? Because that's what this comes down to. Tariffs apply pressure today. Digital assets fight for relevance tomorrow. Gold stands as the backstop when confidence wobbles. Together, they form a layered response to a changing global order. But the outcome won't be decided by one headline or one announcement. It'll be decided by what central banks quietly buy, what companies quietly settle in, and what people around the world quietly trust when things get unstable. If you want to understand the next decade, don't just watch elections and speeches. Watch reserves, settlement rails, and the assets governments treat like insurance. Now I want your take. Do you think this three-part strategy slows the shift away from dollar dominance or speeds it up? And if you were a smaller country caught in the middle, would you choose open digital networks or state-controlled digital currency systems? Drop your answer in the comments. If you want more deep pattern-based breakdowns like this, hit like, subscribe, and turn on notifications. Because the biggest battles are rarely loud. They're quiet. And they decide the rules everyone else has to live by.